Okay, now let's talk about deposit insurance. So, at your local bank, you might have an account and you might have some money in that account. So, what do you think will happen when, God forbid, if that bank goes bankrupt, which means it runs out of money and is not able to pay you your balance back? So, in that case, usually what happens is that the local central bank guarantees your deposit up to a certain amount. So, for example, in the United States, that is up to $250, $250,000. And how does this happen? The banks themselves actually pay the insurance premiums for getting this deposit insurance. So this is a good thing, obviously, because it reassures the interest of the public in the banking system. But however, there is also a negative point over here, which is the moral hazard. And what that is that because people feel safe regarding their funds at the bank, they don't really look at what is the risky business that the bank is doing, right? And what then banks could do is they could offer higher interest rates to attract more deposit, and then they could use that deposit for making riskier loans. Now, if that deposit insurance wasn't there, right, if that deposit insurance wasn't there, you as a depositor would be getting worried because you would see, oh my God, look, this bank is making such risky loans. What if they don't get the money back? And if they don't get the money back, they're not going to be able to pay me back. So I will lose my money. But since that deposit insurance is there, you're not worried about it. And if the banks pay a higher interest rate to attract more deposits will come, and then the bank will be able to make risky loans to earn a higher interest rate, and then obviously make a fatter net interest margin for itself. So this is what is known as a moral hazard. If the deposit insurance was not in place, so without the deposit insurance in place, what would happen is the depositors would notice the higher risk the bank is taking and they would withdraw their funds. But since the deposit insurance is there, the depositors are okay and the bank gets to take higher risk. Now, how do we as risk managers, either thinking from the bank's own department or thinking from the regulator's perspective, how can we control this, right? So remember, we said that it's the banks that are paying the insurance premiums, right, for that deposit insurance. So maybe what we can do, and this is what should be done as well, is that the bank which is taking higher risk would then be, so one way to address this problem is that the bank which is taking higher risk, riskier banks, should be required to pay higher deposit insurance premiums than less risky banks, right? And this would then discourage the banks from taking larger risks. So this way, the deposit insurance stays in place. It's good for the depositors. They feel safe, they feel secure, and at the same time, you're in a way penalizing or discouraging banks from taking higher risk because you're increasing the premiums they have to pay in case if they are taking more risk and making riskier loans. Okay, now let's move on to investment banking. So investment banks do a number of things, right? The biggest thing we're going to discuss first, which is, so over here it's written that this process is referred to as underwriting, but what I would say is that this process is referred to as origination, right? And in banks, what you have is a department. In investment banks, you have a department called origination, and usually that department is clubbed with advisory as well. And we will talk about what happens in the advisory department. But first, let's talk about origination. And underwriting comes under that, right? Underwriting comes under that. So origination is basically where a new security is originated. It is being born, it is being started. So let's say there is a company, and this company is a private company and it wants to expand, right? There's a private company and it wants to expand and it needs money. So it comes to the investment bank and it asks the investment bank to help it raise money from the stock market. So let's say this is the stock market, and the stock market has a lot of investors coming to it, right? So what the investment bank will then do is that this company will allow it to sell a certain portion of its equity or shares, right, to investors in the stock market, and then they will get the money from those investors and pay it to this company. So then this company can then expand its business and grow, right? And this process is called underwriting. But then within underwriting, what we will see is that it's not necessary that the investment bank is taking the responsibility for this entire issue. Let's say, for example, if they want to sell 100 million shares into $10 per share, right? So that is $1 billion. And if the investment bank says, hey, don't worry, I will make sure you get $1 billion, right? Which is $10 per share into 100 million shares. So then that is called an underwritten IPO, where the investment bank is taking that responsibility. But where the investment bank is not taking that responsibility, they are just going to do their best to try and get you that $1 billion. That is known as a best effort, and we will see the difference between those two going forward, right? But I just wanted to tell you that this process is referred to as origination, and part of that is underwriting, as we will see forward. Going forward. Now, this can be done for shares, which is equity. It can also be done for bonds, right? So maybe this private company doesn't want to sell their shares. They don't want to share their ownership with others. So instead of selling shares, they want to sell bonds. So an investment bank can actually help a company raise money by selling bonds as well. And then there are other type of securities as well, which could be a various combination of like bonds, which can be convertible to stocks. Those are called convertible bonds. You can have preferred shares, which is like equity, but it's not like normal shares, which is common stock. It's preferred stock, which can also be later converted to common stock if they are convertible. And I don't want to go into the details of all that right now, but there could be other securities as well. Now, either these new securities are sold to the general public, which is usually in the case of an IPO, or if the company has already sold shares once, then it will be called a seasoned offering or a secondary offering, right? Or it can be just sold to a small number of sophisticated institutional investors, when that is called a private placement. There are pros and cons of both, right? Private placement is relatively easier to do. You don't have to go out and market to the public at large. But then obviously the market size or the target audience is much smaller in a private placement. In a public offering, of course, you're going out to everybody, and you could potentially get a much higher price per share in a public offering, but it is harder to do. It's more complicated. Now we're coming into the details of the underwriting part. Now this is where the underwriting is happening in the firm commitment. Now think about the example I was giving you, that the $10 per share into the 100 million shares. If the investment bank is guaranteeing to the company that, hey, don't worry, we are going to make sure you're going to get at least $1 billion, which is $10 per share into 100 million shares, because the company obviously has to plan their capital expansion, right? They need their capital expenditure to be there so that they can buy the new piece of land, buy the new piece of machinery that they're planning, and so on and so forth. So obviously the company would like this, that the investment bank gives them a firm commitment that yes, don't worry, we are guaranteeing to sell these securities at an agreed upon price, which is the minimum. This will be the minimum. And what is the benefit for the bank to take this risk? In this scenario, what happens, that the bank buys the securities from the company and sells them to the public at a higher price. So if they are able to sell it for $20 a share, they're going to make $1 billion profit, right? They're going to make $1 billion profit. And that's why investment banks make so much money. But then obviously you have to understand the risk involved, because if the bank misjudges the market and is not able to sell the whole issue, right, it will incur a loss because it has made a commitment to the company that I will pay you the $1 billion. Now, if they are not able to raise that much from the market, then they're going to lose money. So this is obviously a very risky option for the bank, but then that risk can bring a huge return as well if you correctly judge the market. And the trick here, which we will see on the next slide, is that you should have a lower commitment in place, right? So to be able to convince the company to sell their shares at a relatively lower price, and then that makes it a lot easier for the investment bank to then get more money from the market than what they have to pay to the company. But we'll discuss that on the next slide. Before I get into how investment banks actually make it easy for them to make money on the firm commitment, let me first talk about the best effort basis. Now, here there is no commitment, right? There's no commitment. The bank is saying, hey, I'll just do my best to sell these securities at the agreed price. Whatever is sold, just give me a certain percentage of that as a fees, right? 1%, 2%, whatever. Depends on the negotiation. But here there is no risk for the bank. It's a much less riskier option for the bank. And obviously here we're talking about public offering, right? Within private placement, of course, there is just an agreed fee that we will just market your issue to the private institutional or leading or selected group of institutional investors. But when you go for a public offering, either you can go for a best effort basis where there is hardly any risk on the bank. They're just going to invest their effort and try to do a best effort and earn a certain percentage of the money that they are able to raise for their client, which is the company. But a firm commitment, of course, this is a much riskier option from the bank's perspective, but could pay out a lot as well. Now, how do they go about making it easy for themselves? So investment banks, what they do is they first would like to convince the company that, hey, your share is actually not worth $10, your share is actually worth $5, right? And then they will try to set the IPO price below their best estimate of the company's value. Of course, I'm not blaming investment banks. I'm just trying to explain a concept to you, that why we see that shares after IPO, or shares usually are oversubscribed at IPOs, and then they even perform very well, is because they're usually issued at a price which is much lower, or which is below the best estimate of the company's value. So if something is worth $10 and you are issuing it at 5, what do you think is going to happen? It will be oversubscribed. That means people will line up to buy that share. They will line up to buy that share at 5, and then eventually the price will probably open at 10, and then even after that it will go up a little bit. So this is what happens in IPOs, and this makes it a very good deal for the investment bank because they are able to raise more money than they have to pay to the company, right? How do the company owners and the investment bank agree on this price of 5? Because obviously, since the company shares are not yet traded, it's very difficult to predict the share price. So what they do is they actually use financial models which use the projected cash flow of the company, and then they discount it back to the present value, and then they say, okay, this is what your company is worth today, right? And then they go for an IPO where they take the shares to the public at the first time. Of course, then you can have your secondary offerings or seasoned offerings, as they're also called. And those are relatively much easier than the initial public offerings, right? This is the first time that you're taking your shares to the public. Another very nice way of price discovery is the Dutch auction, and this favors the buyers. So even though it starts with a price, so the auction price starts with a price that is greater than what any bidder is willing to pay, but then it comes down. So the price is gradually decreased until a bidder is found, and then it is decreased further because the bidder might not be willing to buy all the quantity, right? So it is then reduced further until the entire issue has been sold. So let's say you're coming up with 100 million shares, and you need to sell them. You try to sell them at $10 a share, but nobody is willing to buy. You reduce to, let's say, $9 a share, and you get a order, or you get a buyer for 10 million shares, but you need to still sell a 90 million more, right? Because the total offer is for 100 million, and then you reduce the price to, let's say, 8, and then here the whole market clears, which means all the 100 million shares are bought. Now this person who put in an order to buy 10 million shares at 9 will also get the price of 8. So the price at which the whole lot is sold is the price that all bidders will pay. So the Dutch auction favors the buyers in a way that even if you put a higher price initially, but the eventual price at which the whole issue is clearing is lower, you will not have to pay 9, even you will end up paying 8. And this theoretically is the equilibrium price at which the demand and supply intersect, even though there was demand at a higher price as well, but it was not for the full issue. So the price at which the full issue is sold, that is the price at which the IPO price will be there, and this should be close to what the share should trade afterwards as well. That since it has already come to that equilibrium price, and then the market price is supposed to be the equilibrium price, so therefore it should trade at that price post IPO as well. Now, remember I told you that you have origination and then you have advisory. So in large investment banks, you have this department, origination and advisory, and where origination is coming up with these new securities and doing the IPOs, whereas the advisory is giving service and advice to companies on mergers, whether to merge with another company, or to acquire another company, or to maybe sell a business division of their from the existing company, maybe to restructure companies, where you can have you can set a different division under a different management and then shift focus. And like recently there we have your GSK, which is GlaxoSmithKline, a British pharmaceutical company. They took some of their brands like Sensodyne, and they made it into a consumer healthcare business. I believe it's called Helion, maybe, and then they've basically separated their pharma business into consumer and then the other more complicated one. So that they restructured it, and maybe an investment bank helped them do it. So why would you go about doing it? Maybe you want to separate a business and sell it off, right? You want to calculate the value of a certain business or your business division, and investment banks help companies do that as well. Investment banks also use the money they have for trading. This is not a good thing, right? This is not encouraged, and especially after the 2008 financial crisis, many countries have imposed regulations which limit the extent to which these banks can do speculative trading, because this is not their core expertise, right? They're not an investment fund, they're not a hedge fund, they're not a pooled investment vehicle where people are depositing money because the company or the firm is actually focused on generating return on that investment, right? An investment bank's core focus is not trading, it is supposed to be origination and advisory. But investment banks do have trading, proprietary trading going on, where they use the firm money, where they use their own money to trade, and this is discouraged. And another reason why this should be discouraged is because investment banks have access to material private information. What does that mean? So material means anything which is of significant economic value, and private means that not known to everybody else. So if you are doing an IPO for a company, you know what the share is worth. If you're doing mergers and acquisition advisory for a company, you know what the share is worth. You have access to the internal data, and so that's clearly not a good thing, that because since you have access to that data, you should not be allowed to trade in the market because you have more information than others, and it puts you at an advantage and puts others at a disadvantage. So investment bankings are discouraged, and not only for this reason, but also because if they get into speculative trading using their own firm's money, then it could wipe out their own equity, and if their own equity gets wiped out, then they will come down, and then they usually owe each other money as well, right? So you might have Goldman Sachs owing money to Morgan Stanley, and Morgan Stanley owing money to JP Morgan. And if, let's say, for example, Goldman Sachs goes down, God forbid, right? Then Morgan Stanley could go down. And if Morgan Stanley goes down, then JP Morgan could go down. And before we know it, the whole financial system might be coming crashing down because they're all owing money to each other, right? So that's why we don't want to encourage speculative trading in this area. So that is it for your deposit insurance and your investment banking sections. And I will see you in the third part of this reading these videos.